said, I'm Jim Pullman. I represent the Coalition for Fixed Index Products. I will not take 5 minutes, and I will be very, very brief, but I first of all want to thank Coyle for your position on SEC Rule 151A, and that is basically the rule that the Securities and Exchange Commission promulgated to classify fixed index products as a security so they can be regulated from the federal government level rather than the states or in conjunction with the states. If you'll remember, over a year ago, the SEC promulgated Rule 151A. Coyle at the time filed a comment letter opposed to the rule, which we appreciate very much, along with the NEIC. They received over 4,000 comment letters, over 90% of them opposed, and we appreciate Coyle's position on that. Since then, the NEIC and Coyle at the time also filed as petitioners to basically have the rule vacated with federal court. The federal court came back and said that the SEC had the authority to classify the product as a security, but remanded back, or basically sent back the rule to the SEC because they concluded that they did not do a proper analysis on the competition, efficiency, and capital formation that the rule would affect. And so the rule has been sent back to the Securities and Exchange Commission. A separate motion, by the way, has been filed with the federal court, basically saying we have this 2011 date out there that the rule becomes effective, which basically changes the distribution channels of which these products are going to have to be sold, because all of the folks that sell the product have an insurance license, and they will now have to become securities licensed, and insurance companies will have to change their distribution systems. There's costs that go along with that. And as this rule sits out there in flux, companies are still having to prepare for that effective date, not knowing what, if anything, the SEC will do with the rule. So last week, the court has asked all the parties involved and companies that have filed the motion to brief that. The briefs are due next week, and we will hope to get some direction from the court on what the SEC will do. As I said, the SEC sits with this rule, basically wondering what they're going to do with it if they continue to, if they're going to do the analysis that the court has asked them to do, or if they're going to just basically ignore the court's opinion and move forward with the rule, or if they're just going to hang and shelve the rule and decide that the states are doing an adequate job of regulating the product to begin with. As an aside, we appreciate Coyle, Jordan, and Mike's involvement with the members of Congress. There are 2 pending bills in Congress to overturn Rule 151A. The first is a House bill sponsored by Greg Meeks of New York and Tom Price of Georgia that has 59 co-sponsors of the legislation, many of whom are on the Capital Markets Subcommittee of the House Financial Services Committee, and then obviously members of the House Financial Services Committee. A very strong bipartisan bill that the number of sponsors is climbing every day, it seems like, in an interest to keep these products regulated at the state level. There is a Senate bill sponsored by Senator Ben Nelson of Nebraska and Saxby Chambliss of Georgia that has 10 co-sponsors of it in the Senate. And so, again, a bipartisan sponsored bill to keep these products regulated at the state level. Your Washington, D.C. staff and Jordan have been very active on this, and we appreciate that very much, and their attention to this, and have been representing you folks as members very well. And we work to continue to have negotiations or discussions with the SEC to maintain these products being regulated at the state level, and also work from a political standpoint with members of Congress to get their feedback and their support of these 2 bills to make sure that state regulation is maintained. Mr. Chairman, that was very quick, but I appreciate Coyle's support of the issue.
Are there any quick questions to Mr. Pullman? Okay.
Just 1 or 2 quick questions. You may or may not know the answer. What is the average commission on this product when it is sold by an insurance agent?
They vary, Mr. Chairman. They vary by products and by company, obviously, and competition does dictate some of that. But many of the companies that I represent have an average commission of about 7 or 8% on the product.
And what would be the commission on a mutual fund sale?
The mutual fund sale, of course, Mr. Chairman, the products are structured much differently, but they can have up to a 2% front load commission, they can have a back end commission, a trailer commission, and of course there are embedded fees with those products as well.
But the commission on the indexed annuity is relatively high, wouldn't you agree?
High compared to a mutual fund, but again, those annuity products that have potentially, let's say, a front-end commission don't have the continued fees that some of the other financial services products have.
Okay. Mr. Chairman, if I got, is that it? Do I have any more time, or?
No, we're running real close on time. We've got several other things. Thank you, Mr. Booth.
Thank you.
Next, we're gonna have a report on NAIC annuity suitability developments, and Mr. Bruning, if you'll come back, and John Gurney with
I don't know.
ACLI.
Of course, I'm opposite to this, but
Is John Bruning?
I'm in that
There he
business.
is.
Thank you, Mr. Chairman.
I want to catch you by surprise.
At the NAIC 2008 Spring National Meeting, the NAIC Life Insurance and Annuities Committee established the suitability of annuity sales working group. That working group is reviewing and considering revisions to the NAIC Suitability and Annuity Transactions Model Reg 275 as part of its charge from the committee to review and consider changes to the suitability and annuity transactions model reg, and to improve the regulation of annuity sales, and to provide insurers uniform guidance in developing the agent training, supervision, and monitoring standards in order to better protect the annuity consumers from unsuitable sales and abusive sales and marketing practices. This review was prompted in part by a letter sent to the NAIC from the chairman of the Senate Special Committee on Aging, Herb Call from Wisconsin. The letter was sent to the NAIC as a follow-up to a hearing held by that special committee in September 2007 on the use of senior designations and the sale of annuities to seniors. In his letter, Chairman Cole requested that the NAIC conduct a comprehensive review of its suitability standards and, as appropriate, strengthen those standards to address the use